Okay, so good afternoon, everyone. My name is Jesus. I come from FEMFI, Madrid, and today I'm going to talk about my paper, Predicting Market Reactions to News. So for the introduction, let me take you back to 1970 with Fama and friends and the efficient market hypothesis. According to this hypothesis, information is incorporated into prices immediately. However, there's been a vast body of research trying to uncover this, and it's shown that markets are not really efficient. Now, there are still several gaps that remain to be filled, and let me walk you through them. The first issue is that there's still an over-reliance on methods that fail to capture the economic implications, the economic nuances. For example, sentiment analysis categorizes text as positive, negative, or neutral. So let's have this example. So what would a sentiment analysis algorithm do? It would just take words and sentences and map them to a sentiment. And then it will calculate an overall sentiment score. Maybe in this case, it's positive. Then the literature moved to topic models, which basically categorize text into broad themes. In this case, maybe we would have a topic about telecommunications because we're having some telecommunication jargon, some firms. Also, we have terms like market, brokerage, firm, competition, so maybe a topic about business. And finally, because we're talking about Europe, Latin America, or Spain, we would have a geography topic. So still no economics in these algorithms. Then we have these vector-based models, which basically represent text as vectors that are very granular and break down text into many pieces of information. And they basically are represented as an array of numbers, where each of these numbers are basically are basically a piece of information, and then they're all summarized into a point in high dimensional space that is able to capture all the contextual and semantic information. So it's a more sophisticated method, but still doesn't take into account any economics. So today I actually try to introduce a method that improves upon them. The second issue that I see in the literature is that there's still a lack of firm-specific focus. So most studies fail to identify how news affect individual firms. So for example, these papers look at business articles, but then they try to predict the overall market, so the S&P or the DJIA or the VIX. So still named entity recognition is underdeveloped in finance. And finally, this is a small critique. Many papers still rely on headlines for analysis of text. Headlines are there to capture attention and don't tell a full story, so we should look at full articles in order to understand the impact on markets. So my contribution, this paper, is about addressing these three issues by leveraging large language models to achieve an economically nuanced, firm-specific analysis of full news articles to predict market reactions to news. So, two caveats, this is not a paper about big data. I don't have 10 million news articles. I have a reduced data set. And it's not about getting rich implementing the most realistic and sophisticated training strategy. I'm not trying to go to BlackRock with this. I'm actually just trying to introduce a novel methodology for analyzing news articles in a granular and firm-specific way, show the utility of this methodology with a reduced data set, and trying to understand market reactions by building a simple trading strategy. So now the data is just 2,600 Spanish business articles from Dow Jones Newswires, and they span the period from June 2020 to September 2021. So this is, you may recognize this period as COVID era, which is especially volatile and unstable period, and it's perfect for testing a new methodology because it's very unstable and it's difficult for methods to generalize in this type of sample. These articles have been filtered to explicitly mention IBEX 35 firms, which are the largest cap in Spain. They're most liquid and traded stocks, so they get consistent media coverage. So they're high quality firms. And the firm identification from news articles is basically done first through regex. So we find the pattern of the ticker. This is a characteristic from Dow Jones. That's why we choose it as our data provider. We validate this firm identification with an LLM, and then we filter for IBEX 35 firms. So some summary statistics. The three main words are empresa, compañía, España, so firm, company in Spain. Meaning this is really a business article database about Spain. And I have between 5 and 10 news articles per day, and they are between 70 and 250 words long. So relatively succinct, but directly they go to the point. And then the time series is quite spiky, so maybe one day we have a lot of attention, a lot of articles, and then it drops the next day. And basically what I do is partition the data sample into three subsamples, which is basically the training, validation, and test. Right? And the purpose of these splits are there for a reason. They're not random, and you see that they are sequential. So now let's go into the methodology, which is, I think, the most important thing about the paper. So I used to present this paper going into a lot of technical details of what I do, but I realized that this is really not the point, and that I can basically walk you through how I understand what I do in my methodology, and it's much more useful. So how do we humans understand information? So pretend we're humans, actually, I think we are. And let's read an article. Do we think of this article as basically something positive, neutral, or negative, as a linguistic would do it? Maybe not. Do we decompose it as the topic structure? Probably not. And probably we don't think about it as a vector in R512. So let's see how we would think about this article. So let's read it. Telefónica's subsidiary, Telxius Telecom, has agreed to sell its telecommunications tower division in Europe and Latin America to an American company, American Tower, which will expand its presence in Europe and increase competition for the Spanish wireless telecommunications group, Telnex Telecom. And this transaction represents the entry of a new independent tower operator into the Spanish market and potentially more competition for future growth in the European market. Okay, so from this article, what we may infer is that there are two Spanish firms involved, Telefónica and Telnex. So for Telefónica, it has this subsidiary who's selling this tower division. So it means that it's getting money from the sale, and it's potentially divesting from something he's no longer interested in and putting it into a much better opportunity. So it's a positive thing for Telefónica in the short term, as it generates cash flow for further investment in other type of business, but it's not a big deal. Now Telnex expects more competition, so this is bad news in the short term, but it's not gonna be the end of the world either in the short term. Now, how can we mimic this process of human reading by using a large language model? Well, my approach, the methodology that I introduce, is basically defining a human mimic and news parser through a function calling a schema. So basically this schema is giving a recipe to a chef. And our chef is going to be our LLM, which is Llama 70 billion. So how does this recipe work? Well, we basically feed our database to the large language model. And we say, okay, for each article, identify the set of Spanish firms from the IBEX 35 that are directly affected by the article. Ignore irrelevant mentions to other firms for mere context. Ignore firms that are not publicly traded. Ignore the rest. And then for each firm in this set of firms, classify the news implied firm-specific shock in that firm according to this schema. We provide classification according to the shock type, so demand, supply, financial, technological, policy. The magnitude, is it a minor or a major shock? And finally, how is it expected to affect the firm, in a positive or in a negative way? And then I want the LLM to justify your choice, because we got experience with ChatGPT and it hallucinates a lot. So we want to know exactly why it is doing what it's doing. So let's see it in action. And actually, this is extracted from the paper. So I'm not making this up in order to look good in the presentation. This is exactly how it does it. So first, the chef has to extract the firms from the article, and it does it. It's simple, because we got the help from this pattern from Dow Jones Newswire. So it's simple. Then it will produce a shock classification according to our categories. And the most important thing is, okay, justify what you're doing, because otherwise it could be anything. Okay, so in this case, it says that Telnex is suffering a supply minor negative shock. And why is it the case? Well, it says the news about American Tower's expansion in Europe may increase competition for Telnex, which is why it's classified as a minor negative supply shock. It sounds reasonable, it sounds competitive. On the other hand, Telefónica benefits from the sale of its tower division, which is why it's classified as a minor positive financial shock. We could agree or we could disagree, but it sounds reasonable. It sounds like something we could come up with. So now we have these three methods that were completely naive on economic terms. It was a there are linguistic approaches that really ignore economic implications. But now I introduce this new methodology which is able to capture the financial shocks that are implied by news on firms. So now in order to really test my methodology, we need to compare it. Now I could compare it to any of those methods, but I choose to compare it with this one. Why? Well, there are two reasons for this. First, a intuitive reason. This is the most sophisticated method out there. So it makes sense to take the best benchmark. On the other hand, this vector-based embedding model is actually the first layer in any large language model, which makes sense basically because we're going to compare the first layer of the LLM with the last layer of the LLM. So we are going to see how by guiding our LLM through the recipe that I presented you, we're getting a more sophisticated and granular firm-specific analysis of economic shocks. So now some technicalities before I show you the results. What I'm going to do is construct clusters of articles. And the reason why I'm doing this is similar to portfolio sorts. So in portfolio sorts, we take deciles according to a variable. In this case, we're going to do clustering of news articles, and then we're going to select optimal clusters to go long or go short in for our trading strategy. Okay, so for the first step for clustering, for the vector-based model, which was the benchmark, we're going to do k-means. Okay, so we're going to do it with 26 clusters, and this is a hyperparameter that we get in the training sample. Okay, so this is going to look something like this. We got the vectors in the high dimensional plane, and then we get the clusters according to the k-means. On the other hand, now I show you an example of what these clusters look like in my database. I had 26, but I'm only showing you 12, just to not go too long on this. So we see that the clusters are actually firm-specific and industry-specific. So it looks like the embeddings model is actually quite good. It understands firm or industry-specific mentions. So it shows that there's some economics actually in this embeddings model. Okay? And then for our model, for our LLM-based model, we're using Llama 370 billion. And the way we're going to cluster is by taking the Cartesian product of the shock classifications. That means that we're taking every possible combination. So supply minor positive, supply minor negative, supply major positive, supply major negative, and so on and so forth. So it's going to deliver 20 clusters. So now we're going to see them in action. And now the clusters are based on firm-specific economic shocks. So when an article implies a supply major positive shock on a firm, then it goes here, and so on and so forth. Now for the trading strategy, we're going to construct the stock market positions for each article and firm, and they're going to be market beta neutral, which basically will deliver abnormal returns, and they will be held for 4 days. Okay, that's more or less how it looks like. The trading strategy, as I told you, is a long-short cluster-based trading, similar to portfolio long-short strategies. And in order to select the optimal clusters, we have 2 algorithms. I'm not going to go over this. In the paper, you can find it. But basically, 2 algorithms. Greedy maximizes the performance in the validation sample, and stable kind of like stabilizes the performance between the training and validation sample. So it doesn't maximize performance in the validation, but it goes like trying to make it stable in both samples. Now these the legs, long and short, are upper bounded by a hyperparameter, and these L and theta hyperparameters are chosen in the validation sample. So now let's go to the important stuff, the results. Okay, so first I'm going to show you the distribution of articles through the clusters. So this is the benchmark, okay, the embeddings. So what we see is that in the different samples, so training, validation, and test, the distribution profiles are very different, which shows that there is temporal instability in the distribution of articles through the clusters. In the case of our LLM-based model, the distribution is very stable, and it doesn't matter what sample you get, and even if you do it for the full sample, you get the same type of distribution. So temporal stability. 5 minutes. Now let's look at the trading signals. Okay, so now it's where we look at the clusters and the trading signal that its cluster implies. So again, two algorithms, greedy and stable. So what we see is that there is an over-reliance of signals on the past performance of a cluster. Because for example, look at clusters 21 and 22. They're clusters about the financial performance of Repsol and Aena. And our algorithms say go long. And why is it the case? Well, because in the training and validation sample, these firms are doing very well. Now in the test data, this may not be the case. So saying, okay, what should I do? Go long. Well, it might be the case that it's no longer a good decision. So these signals are short-lived due to temporal instability, which is basically present in the nature of firms. Now, in our LLM-based model, signals are based on economic shocks, meaning that today, yesterday, tomorrow, trading based on when an article implies a financial minor negative shock on a firm will make sense in any type of in any time period. So they're long-lasting signals, and then they depend on the nature of the firm's specific shock, different to the embeddings model. So now we go to the trading strategy, which is where we see the trading in action. In the case of the embeddings model, what we see is what is expected. Okay, so in the training and validation sample, the greedy algorithm is going to do well here because it's trained on this data. Stable algorithm is going to do well on both data samples. It's trained on both of them, but what matters is this, the test data. So we see that it's not producing a stable, profitable strategy, okay? So it's basically poor. It doesn't generalize well out of sample, okay? Now, in the case of our LLM-based model, we see that in the out of sample, we're able to generate profitability. So this shows that there is an improved temporal generalizability of the method, and even in the out of sample, we're able to anticipate the market trends. That means that we're able to buy winners and sell losers. Again, we're not accounting for many market frictions that could be out there, like slippage or trading costs. But this is a paper about the economics of this. We're trying to understand the market reactions to news, not trying to make the profit to sell this to BlackRock. So let me conclude. In this paper, basically we guided an LLM, we guided our chef through the news parsing schema, and we were able to obtain a structural analysis of news implied firm-specific economic shocks. And even in a volatile period, such as the COVID era, the LLM-based method produced stable distribution profiles of articles through clusters across the different data splits, which is basically across time. This shows that there is temporal stability in this methodology. The LLM-based trading signals are both long-lasting and economically relevant, as they're based on economic shocks. We're trading economic shocks. And the LLM-based trading strategy effectively identifies winners and losers, illustrating the sparse's ability to anticipate market trends by comprehending the market implication of economic shocks. And with this, I'm done. So thank you very much for your attention.